Ladies and gentlemen, the mortgage tsunami just unleashed. Mortgage rates in Britain hit 15-year high, with many fearful there is more misery to come. The average level of a 2-year fixed deal now stands at 6.66%, according to MoneyFact, a modest increase from Monday. Market analysts suspect that higher mortgage rates will contribute to weaker economic activity in early 2024, and they are now ruling out a technical recession in the first half of next year. UK households are facing an avalanche of cost pressures triggered by a rising interest rate and the worst cost of living crisis in a generation. Millions of homeowners have seen the value of their homes decline this year, with some analysts forecasting a double-digit drop in prices as the nation adapts to costlier borrowing. Meanwhile, lenders are hiking the cost of loans, pulling deals off the market and tightening borrowing criteria, making it harder for first-time buyers to get on the property ladder. Mortgage rates have reached a 15-year high, overtaking the level seen during the aftermath of Liz Truss's mini-budget. The Bank of England has been raising interest rates sharply since December 2021, when they stood at 0.1% to reach 5% in order to tame the stubborn inflation. The UK's inflation currently stood at 8.7%. Besides, recent growth in wages may further push the Bank of England to hike interest rate in its upcoming meeting. According to the latest report, UK wages have risen at a record annual pace, fueling fears that inflation will stay high for longer. Regular pay grew by 7.3% in the March to May period from a year earlier. Official figures show equaling the highest growth rate last month. This could prompt further waves of mortgage rate increases, spelling yet more misery for homeowners. Chief Executive of lender Empowered Mortgages expect the average 2-year fixed rate deal to breach the 7% mark before the end of the year. Homeowners and buyers are rushing to lock in deals as rates keep increasing amid the ongoing chaos in the mortgage market. The value of remortgages written by Knight Frank Finance increased by 41% during May and June compared with the previous 2 months period. Lenders have been swamped by applications and are being forced to pull deals off the market to reprice. UK mortgage holders have a fresh financial worry to deal with after a key lending rate surged to its highest in almost 15 years. The average 2-year fixed residential mortgage rate climbed to 6.66%, narrowly exceeding the 6.65% touched on October 20 last year, and the highest since August 2008 when it stood at 6.94%. Britain's housing market activity staged a recovery in early 2023 from the turmoil triggered by the unfunded tax-cutting plans of former Prime Minister Liz Truss. But homeowners and buyers have faced renewed mortgage pain in recent months. Fixed mortgage deal rates have risen rapidly in recent weeks than expected. Consumer price inflation, which held at 8.7% in May, pushed up bond yields and increased market bets on the Bank of England benchmark rate, peaking at 6.5%, up from 5% now. Governor Andrew Bailey said last month there were signs of more persistent underlying inflation pressures after the Bank of England unexpectedly raised its bank rate to 5% in an effort to tame the highest inflation rate among the world's big rich economies. Trade body UK Finance estimates 800,000 Britons will need to refinance loan in the second half of this year, and a further 1.6 million in 2024 of a total of nearly 7 million fixed-rate mortgages that are outstanding. Analysis from Resolution Foundation, a think tank, suggests that the average homeowner who refinance a home loan in 2024 will have to pay an extra £2,900 a year. Halifax, which is the UK's largest lender, said that the property prices in June fell at the fastest annual pace since 2011. House prices have also shown the hit to the market. Mortgage lender Halifax reported a 2.6% annual fall in house prices in June, the largest decline since 2011, while Nationwide reported a 3.5% drop year-on-year last month, the biggest since 2009. A person with a 200,000 mortgage would pay £343 more in monthly repayments if taking out a loan today compared with a year ago. The decline in UK house prices accelerated in June, according to the Nationwide Building Society, fueling concerns about the impact of soaring mortgage rate on borrowers. The average home price fell down 4% from its peak last August, but is still well above pre-pandemic levels. Borrowers are facing a steep rise in mortgage costs as the Bank of England ratcheted up interest rates to counter surprisingly resilient inflation. Investors expect the central bank will force to bump up the rate above 6%. Goldman Sachs has just published a new report on the UK mortgage market and monetary policy. In different scenarios, they predict the cost of high mortgage rates on households. Quoted mortgage rates have risen sharply in recent weeks on the back of higher expectations for bank rates. The UK stand out are relatively exposed to mortgage refinancing risk compared to UK or Euro area given short fixation periods. Given that the stock of outstanding residential mortgages total just under £1.7 trillion, the 2.4% rise in the effective rate by 2024 quarter 4 would see interest payment rise by £44 billion or 1.6% of GDP. This is likely to partially offset in near term by lower principal payments. Mortgages are structured such that higher interest mortgages have lower initial principal repayment. Considering the offset from lower principal repayments, Goldman Sachs expects total mortgage payments to rise by £32 billion or 1.2% of GDP by fourth quarter of 2024. The mortgage costs have rocketed, and since bids have relatively short-term mortgages, this is going to hurt individually and for the economy. Why are mortgage rates rising? Rates rose dramatically last autumn in the wake of then Prime Minister Liz Truss's disastrous mini-budget as lending markets reacted to a list of unfunded tax cuts. But they then dropped in the first half of 2023. A new chancellor and prime minister reversed the majority of announcements. However, the economy has continued to be plagued by a high inflation and exacerbated by a strong employment and wage figures, forcing the Bank of England to increase interest rate. On 22nd June, the bank's monetary policy committee voted to increase the base rate by 0.5% to 5%, its 13th consecutive hike. It is now expected to continue increasing the rate until the end of this year as its fight to reach its target of 2% inflation. Around 1.4 million fixed mortgage holders need to remortgage this year and will be facing a mortgage shock as they signed up to much higher rates than their current loan. The rising cost of borrowing is putting increased pressure on households. Over the past week, major lenders including NatWest and Vegemony have put up rates on mortgage products as they struggle to keep them in line with the swap rates. Thank you so much for watching. Please consider like and subscribe my channel.